Hello judges, my name is Rishab and today I'm going to be presenting a stock pitch on Northrop Grumman. Before we get into why Northrop Grumman is a promising stock pick, I would like to explain why the defense sector is going to be the most profitable sector in the future. This is true for 4 reasons. The first one being long-term stability. The defense sector benefits from long-term government defense contracts, ensuring stable revenue and reducing exposure to economic fluctuations. The second main reason is increasing geopolitical tensions. Ongoing global conflicts, such as Russia and Ukraine, lead to increased defense spending, creating strong demand for the advanced technology in the defense sector. The third reason is increasing technological innovation. The defense sector includes companies driving growth in AI, cybersecurity, and autonomous systems, sectors which have been showing substantial year-over-year growth in defense contracts. The fourth and last main reason is consistent sector growth. Global defense spending is projected to grow 4.2% annually, leading to strong capital appreciation and solid returns in the defense sector over the long term. Now that we've established why the defense sector is going to be extremely profitable in the future, that leaves us to answer the question, why is NOC a long-term buy? NOC is a long-term buy for a number of reasons, the first being increased global military spending. Rising global military spending is largely driven by ongoing geopolitical tensions. As a result, nations in Europe are significantly increasing their defense budgets to strengthen security. In the US, the government continues to focus on defense spending, with an emphasis on peace through defense. NOC Company Overview. NOC is consistently one of the top 3 US defense contractors, generating over $40 billion in annual revenue. The company has a record backlog of approximately $91 billion in orders, providing strong visibility into future performance. NOC also has an extremely diversified portfolio, with products in 4 industries: aerospace, defense, mission systems, and space exploration. This gives it a significant edge over competitors. Financial performance and outlook. While recent financial results reflect some underperformance due to significant contracts still in the initial production phases, these contracts are expected to become profitable as production progresses in the coming years. Overall, NOC is well positioned in a growing global defense market with solid order pipeline and strong long-term growth prospects. Although short-term performance may face challenges, the outlook remains positive, fueled by increasing demand for defense solutions. Company at a glance. NOC Corporation is one of the top contractors in the aerospace and defense sector worldwide. NOC has a diverse portfolio with developed products in 4 markets: military and aerospace, land and sea defense, mission systems, and space exploration. Involved in multiple industries, NOC specializes in particular products and services in each industry as shown below. NOC's products are absolutely vital for the national security of every nation in the world. NOC is based in offering innovative technologies and systems in defense, aerospace, cybersecurity, and space exploration. NOC's $43 billion revenue in 2024 consisted of 4 very consistent revenue streams from each of the 4 sectors. NOC's record order backlog of $91 billion, combined with its consistency from all sectors, confirms its status as a top defense contractor. Company at a glance continued. NOC sales by geography. NOC has a geographically concentrated revenue base in the United States of America, where it collected approximately 86% of its overall revenue from long-term government contracts during 2024. Northrop Grumman is also a major client for the DoD, NASA, and Department of Homeland Security. NOC's international sales represent about 12% of its sales, with the bulk of non-US clients located in Europe and Asia. However, with the rising level of global defense spending, in light of increasing geopolitical tensions, NOC is now looking to expand international presence and currently targets NATO countries to extend its global footprint. Porter's 5 forces. Threat of new entrants. Insignificant threat. Due to high barrier entries, including capital costs, complex technology, tight regulations, and governmental relations, it is highly unlikely that any new entrants can pose a threat to NOC. Bargaining power of suppliers. Moderate to low threat. The power of suppliers of NOC is offset by a diverse supply chain and the fact that specific items necessary to various types of agreements will give the supplier low to moderate bargaining power. Buyer bargaining power. Low threat. NOC's primary customer is the U.S. government. Payment is received via long-term contracting, so if a government agreement is in place, NOC has a reliable source of revenue until that agreement is over. Threat of substitutes. Low threat. Direct substitutes for NOC's work or products are limited due to the specific nature of what is produced. Industry rivalry. Moderate threat. Other defense contractors, such as Lockheed Martin and Boeing, can present some threat to Northrop Grumman. However, due to NOC's diverse products and services in its portfolio, the construct of industry rivalry represents less of a threat to NOC than it would to either Lockheed Martin or Boeing. For instance, if LMT or Boeing beat NOC in a contract for an aerospace vehicle, NOC can still rely on its other sectors. In this chart below, you can see the stock price performance over the last 5 years for Northrop Grumman, Lockheed Martin, the ITA, which is the ETF for defense and aerospace, and the S&P 500. As you can see, NOC's stock price for the last 5 years has outperformed the ITA, but has significantly underperformed relative to the broader S&P 500 index, indicating substantial room for growth. Financial benchmarking. NOC performed very well financially when compared to Lockheed Martin and General Dynamics, its major competitors. As you can see in the first chart on the top left, the revenue growth of all three companies was very similar over the last 5 years. However, there is a much significant difference in the other three ratios, starting with operating income. NOC's growth in operating income is above that of competitors by a significant margin. This shows growth outperformance and superior operational efficiency. Higher diluted net income growth. This shows better profitability, more capital deployment, and shows a better ability to generate earnings even with diluted shares, which is very appealing to shareholders. Significant EPS growth. Growth in EPS is much higher than competitors, which means significant value creation, investor confidence, and sustained growth potential. Overall, NOC's results are incredibly compelling for long-term growth in all areas when compared to competitors. This shows strong overall financial management, exceptional shareholder value creation, and sustainable growth for the long term. Valuation benchmarking. Undervalued PE ratio. NOC's PE ratio is 17, lower than Lockheed's 21 and General's 20. This indicates that NOC is undervalued relative to its peers. Attractive EV to EBITDA ratio. NOC's EV/EBITDA ratio is 14.5, lower than Lockheed's 15.1 and General's 15. This lower ratio indicates better value from NOC in regard to operating cash flow, making it cheaper than LMT and GD. EV to sales ratio. NOC's EV sales ratio is 2x, higher than Lockheed's 1.8 and General Dynamics' 1.7. The slightly higher ratio indicates that investors have more confidence in NOC sales growth compared to LMT and GD, indicating strong revenue potential. NOC is undervalued based on the PE and EV/EBITDA ratios. It has a slightly higher EV sales ratio than its peers, showing confidence in sales growth. Overall, NOC is an undervalued company with significant growth potential. Target price. To calculate the target price of NOC, I used two methodologies. The first one was utilizing the P to E ratio. I first found out the future EPS for 2025 on the NOC investor presentations and took the midpoint of the company guidance. I then estimated the PE ratio for NOC in 2025 to be at 20x, because there's no reason that NOC should be trading below Lockheed and General. Lastly, I computed the target price by multiplying the PE ratio with the EPS to yield a target price of $561. For my second methodology, I used the EV sales ratio. I started by calculating the long-term EV sales ratio, which was the average of the EV sales ratios over the last 3 years. Then I found the sales estimate for 2025 by taking the midpoint of the company guidance from the investment presentation, which turned out to be $42,250 million. I then multiplied the sales by the EV sales ratio to find the enterprise value. Next, I calculated the market cap by subtracting debt and adding cash and equivalents to the enterprise value. This equates to $86,836 million. Finally, to find the target price, I divided market cap by number of shares diluted, which equated to $590. Investment risks. NOC's two main risks are changes in government spending and competition. However, both these risks are highly unlikely to cause any damage to Northrop Grumman due to rising geopolitical tensions, Northrop Grumman's stable revenue income, and their diversified portfolio. To close out this segment, NOC is a long-term buy due to its competitive moat, diverse portfolio, and stable revenue income.